Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, I have here another great show coming up. I have Nick Ameluxen. You just have to love the last name. You know it's going to be a great show with a last name like that. Nick, how are you, man?
Good. I appreciate the love for the last name.
Oh, you're very welcome, bud. Hey, well, I really appreciate you joining the show. This is We Build Great Apartment Communities, the only show dedicated to taking apartment buildings and finding strategies to develop them into amazing communities. So we'd like to thank you, welcome you to the show. We appreciate your interest in building out great communities and improving how people live. So Nick, tell us a little bit about how you got started in this business. I know you have a pretty cool story, and I think it'd be great to start off sharing with our audience, your story, man, how you got into investing, and, we'll kind of progress through that way.
Yeah, sure. So I initially got started in investing about 2013. I was working as a technician for Volkswagen and Audi for about 10 years. And I worked with a guy who had been at the same shop for about 40 years. And I saw the physical toll it had taken on his body and how cranky he was. And I knew at that point, I wanted to get out, but I wasn't sure where to go. It took me a while to find real estate investing. I started with stocks. I actually invested in the company that I was working with, and that turned out horribly. If anybody remembers Dieselgate, I bought right before that, and eventually sold that in 2019 to go into one of my apartment communities. But about 2015, I bought my first house and started listening to BiggerPockets, and that's what kind of flipped the switch for real estate investing. And then from there, I bought another single family, bought a turnkey, house hacked a duplex, and then realized it was taking way too long to get to where I wanted to be. And I was really enjoying the real estate side of it. And that's when I started looking into multifamily and buying larger communities. And so since the end of 2018 is when I started focusing on that. And since then, my partner and I have closed on about 200 units in Austin, which is where I am.
Awesome, man. So with that said, let me share with our audience, okay, your background. All right. I thought it'd be great to start with your story first and then come back with your background. So Nick is a partner at Quantum Capital, and he specializes in acquisitions and asset management with a portfolio in Los Angeles and in Austin, Texas. So since then, Nick has closed, as he mentioned, over 200 units, okay, with a worth total of about $20 million in Austin, Texas, and he now focuses on real estate full time. So, very cool story that ties in now to some of the things that you're doing today, and of course your background and your track record. So, Nick, real estate is a very unique business, right? Because inside of the world of real estate, and oftentimes you wear different hats, especially when you're learning. So, when you look back on when you first started to where you are today, what were, one or two, three things that you can look back on and say, man, now in hindsight, these were the one or two things that really allowed me to accelerate my growth?
Yeah. The biggest reason for being able to accelerate my growth was just starting to network with people. I mean, reaching out to people who were already doing what I wanted to do and seeing if there was some way that I could help them. I mean, that's how I met my partner. It's how I met my mentor. It was just like, hey, I want to learn more, and being just completely open to that.
So you said networking, right? Mm-hmm. So let's add a little bit of color to that. And the reason why I say that is because in this business, you're going to meet a lot of different people, and not everybody is going to be the right partner for you or the right person to venture with or the right person to invest with. So what made this partnership work for you?
Sure. Yeah. I mean, when it comes to finding a good partner, it's just like finding a good deal. I mean, it's just, it's a numbers game, right? It's not how many people can you meet, and it's how many people can, that align with your interests. And so, I stumbled upon my partner just by reaching out to people, like I mentioned, doing what I wanted to do. And it wasn't the first call and it wasn't the 10th call. It was probably, like the 30th call I had at that point. And we just kind of ended it with, he was in Los Angeles and I'm in Austin. And it was, hey, if I find a deal that looks like this in Austin, would you be interested? And it just kind of snowballed from there. But it was just a gradual process. Got
it. Awesome, man. Really appreciate you sharing that. So Nick, I'm gonna kind of break this down and walk our audience through the process, right? Okay, your process at least. So inside of the world of investing, whether it be a single family residential property, a commercial property, or an apartment building, the process or the cycle is relatively the same, right? For our business, we've broken things down into 4 quadrants, and that's how we break up our business and of course our teams. The first, of course, is you have to find a great deal. So you have to acquire something, you have to know how to underwrite, right? Then you have to be able to finance it, right? Or capitalize the project. And then from there, you have to be able to manage it or have a team in place that can do a really good job of doing that. And then lastly, you have to dispose of the asset somehow, right? In your case, or you have to dispose of the asset, you have to sell it. In your case, you specialize really, it sounds like, in the front end of the process, the acquisition, the acquisition piece or the acquisition component. Mm-hmm. So what are some of the economic trends that you're seeing in multifamily today, Nick, especially with COVID-19, right? What are some of the things that you're seeing that's changing how you approach your acquisition process?
Sure. Well, like I said, the 2 markets we're in are Austin and Los Angeles. So those can't be any more different, right? So I guess for the sake of this conversation, I'll just focus on Austin because that's the one I know much better. For what's changed for us since COVID-19, obviously our underwriting standards have changed for what we're seeing year 1 and year 2, what we predict that we're going to be able to do at a property. Most of what we buy is value add, and we're still looking for that because I really like the ability to force that appreciation because I don't think we're going to be seeing a lot of market appreciation in the coming year, maybe more. But also on the acquisition side, we haven't seen a ton of deal flow. Most people who are bringing anything to market right now, there's not a lot coming to market right now. I mean, it's not like Austin has a huge supply anyways, but what we're seeing is a lot more people kind of testing the waters, but nobody really selling unless they absolutely have to. And I think it's too early right now for seeing any distressed sellers. So we're keeping our eyes open and looking for opportunities. But as of right now, it's just kind of ground to a halt. We're focusing on the asset management sides of the business more.
Okay, so let's talk about that. Let me kind of qualify what you said. So you said that there's nothing really coming to market right now, but people are testing, right? So those 2 kind of go in opposite directions. So let's maybe talk about that. So are you sensing that, there may be some distressed opportunities coming down the pike and you have owners that are testing the market right now, trying to gauge how, buyers are potentially going to be responding to their asking price? Or can you elaborate on that a little bit more?
Yeah, sure. So a lot of the deals that we're seeing, if they are distressed, it's usually people who bought in 2018 or 2019 and got caught in the middle of a reposition, specifically right now, and either have higher vacancy or higher economic occupancy, especially in Austin where they had the eviction moratorium extended. I think the earliest you can evict now is September. So a lot of like C class and even some B classes carrying some large balances. So we've seen some of that. But most of that is loan assumptions, and the what they bought it at isn't what it's worth today. So those deals don't make a lot of sense, but we're keeping our eyes open in that respect. And the other side is a lot of people who've owned for a long time, and I don't know if they feel like maybe they missed out or like missed the top or what's happening. But we've had a lot of off market sellers, and but the pricing just hasn't made sense, and it doesn't seem like they need to sell. So for us, it seems more like they're testing the market.
Got it. Okay. That makes sense. So, you mentioned something that's kind of interesting, and that is the deals that you're looking at right now that are coming to market. There are opportunities. They were repositions in about roughly a year ago, right? And now the operators are stuck, can't move forward, can't get out. They're stuck in a situation now where There's a moratorium on evictions. So probably delinquency a lot higher than it was in the past, right? Taking some losses. I've looked at a couple of those deals as well, and some of them I thought, made sense. Our reasoning for not moving forward with one in particular that I liked and I still like is I'm not sure that we're at the end of the cycle yet. Mm-hmm. So what are your thoughts on that, right? I mean, no one can time the market, right? We don't have a crystal ball, but I know everyone has an opinion on timing to some degree, right? Unless it's an opportunity that you feel is just a great deal, you still have to underwrite for some uncertainty moving forward. So how are you accounting for that, when you guys are looking at opportunities?
Yeah, I think you pretty much just summed it up. We also feel like we're not out of this. There's probably going to be more distressed opportunities coming and maybe some more hardship coming to our properties. And so as we're looking at deals and underwriting, what we're really pouncing on right now is just something that seems like a great deal considering the market. I don't think you can time the market well. I mean, real estate moves a little bit slower than the stock market, so you can kind of catch it's easier, I guess, to catch it on the way up than it is to catch it on the way down. But we're just sticking to our fundamentals, probably even more now than before. We might have our criteria, and before we would flex a little bit when we got close, but now it's being just very picky in what we're going after.
And so can you talk a little bit about what would you flex on, right? So I liked how you said that, right? In the past, hey, when we got really close, we would flex a little bit more on our criteria. Maybe can you summarize maybe what that criteria looks like? And in some cases, what were you willing to be flexible on? And then, how has that changed now where you just, there's no budging certain criteria?
Sure. I guess, so if we're looking at like a heavy reposition, we're looking at a specific cap rate. We're trying to stay within a range, both on cap rate, on price per square foot, price per unit, depending on the area. And those metrics are depending on the area. And then we also factor in how much we're going to have to put in per unit. And if we're looking at a property and we're thinking, it's a little bit below on the going in cap rate than we like, how far is it below and is the upside there? And now it's more like, okay, we can't really budge on that because we really want that positive cash flow year one, especially in these really tight markets.
Right.
So we're less likely to take those risks now because we know it's not likely to see a lot of positive rent growth in the coming 12 months.
Interesting. Really interesting. So I know there are a lot of folks that I'm talking to out there, and it's kind of split down the middle, institutional investors, also private operators. I have some that are already making a predetermination as to, how many points they feel they should be adjusting to a cap rate based on where it was, say, before COVID relative to what's going on right now, right? They'll had 100 basis points to it, depending on the asset class, or 200 basis points. How are you guys looking at that? So you brought it, and the reason why I asked this question, you brought up cap rate. You said, hey, sometimes what we'll do is we'll also evaluate the cap rate to see where we are and to see how much upside we have to that. But in a market like this where you don't have a lot of predictability, how are you pricing your cap rate, right? I mean, you have to make some assumptions there. Are you automatically now adding, for example, if you were typically in a market, a 6 cap market, are you in a Class B asset adding 100 basis points to that, or what's the thought process there?
Sure. A lot like you had mentioned, it doesn't really seem like a seller's market anymore, right? And so while we're not really looking at what we were buying in 2019 and saying, hey, we were paying this cap rate, now we're going to add 100 points on. We're more thinking, at the exit, what can we sell it for at the exit? What do we expect this property to sell in 5 to 7 years? And does that price make sense now? Because right now things are kind of in fluctuation. Like I said, there's either distressed sellers or people testing the market and not a lot in between from what we're seeing.
Sure.
And so it's more, does it make sense to buy now? And is it reasonable that it can sell for this when it's time to exit in 5 to 7 years?
So it really comes down to your understanding of the market, mm-hmm. right? When you're making that analysis, and of course you're making, quite a few assumptions there, but it ultimately comes back to how well you know your market and how well you know the activity that's going on around you, right? Mm-hmm. Would you say that's fair?
I would say that's fair.
Okay, cool, man. Okay, so Nick, let's do this now. Now that we kind of have that background, I'm going to ask you a couple of questions now, just about profitable investments, right? Or some things that you've seen since you've started relative to where you are today. So we talked a little bit about economic trends. We gave our audience, we kind of walked them through this, right? We gave them how you're looking at things in your marketplace. What are some things that you're concerned about as you move forward? How you're accounting for that. So, I'm going to pivot a little bit, okay, and talk about some of the qualities that you see in successful multifamily real estate projects or investors, okay? So based on your experiences today, what would you say are the top 3 qualities that you see in successful multifamily operators?
Oh, wow. That's a good question. I think, the number one thing is integrity. The people that I look up to, I feel like, are people who have a ton of integrity. Adaptability, especially in a business such as this, where things can change in a month.
Right.
Or a week.
That's a good one.
Yeah. And I think the third would just, and maybe this is just from my point of view, would just be strong organizational skills. Because there's a lot of moving parts.
So give us an example of that, right? Can you give some examples of organizational skills that have proven to be critical for you to being able to execute not only on your business plan, but the closing of your acquisitions? Maybe the business plan, maybe share a little bit of both, right? Things that are important to you being able to close on time, and then of course, maybe some of the requirements to be able to execute on the business plan that was predetermined prior to closing on the property, because that's a really important component.
Sure. As far as organization goes, when it comes to closing, as anybody who's been through one before knows, there's just a ton of moving parts as you're trying to get a deal across the finish line. You've got lenders, you've got appraisals, you've got inspections, you've got a bunch of different things, and they all kind of culminate at different times. And then you're on this time frame where you're trying to close within 60 days or however short or long your closing period is. So being able to manage that efficiently is pretty valuable. It takes a huge load off as well if you have somebody on your team who can kind of step up and quarterback that process well.
Interesting.
And it's the same with the business plan. Everybody goes in, you have your acquisition underwriting, you have your plan, you have your investors, you tell them what you're going to do. But when it comes time to do it, who's coordinating all that? Who's keeping it on schedule? Who's, checking in with your GCs and your management company to make sure everything's progressing as it should? Who's working with the lender if you've got holdbacks and things like that? And there's just a lot of things that can fall through the cracks. You don't really notice until a few months out. So
Right.
Yeah.
So Nick, one of the things that we're really adamant about in our companies is process and systems, right? I think the longer you're in this business, the more important process and systems become. We started off refining our process with checklists, and then we took that and we started automating that process, converting that into systems. You talked a lot about, I heard you in your language, I picked up the words coordinate. So how were you guys managing or coordinating at this point, say the acquisition process, right? The due diligence process. Are you using checklists? Do you have a specific system in place? What do you like about that? What do you not like? And I'm asking because, our viewers or our listeners for that matter, just to give them, we got to paint a picture of what some of this stuff looks like, because most of these folks are listening or watching. So if you can elaborate on that, man, that would be great.
Sure. When it comes to acquisitions, from start to finish, and I won't go into huge depth, but let's say a deal comes across our desk. The first thing we do is we have our our underwriting kind of format that we've started. And we use Asana, but really any, checklist or whatever you want to do, that's just what we use because it's easier for us. And we just run through that, right? We're looking at, first we look at high value metrics. Does it fit these metrics that we're looking at? And if it does, we go a step further, right? And then we're looking at crime. At this point, we already know the area. So I guess that's the first metric. Is it an area we want to buy at?
Right.
And then it goes, look at the overall financials. Does it seem like it could work based on what we've been given? If so, take it, all the way through this. And for that, we use a checklist. I mean, essentially Asana is just a checklist. And I forgot what was the part after that question.
No, that's fine. That's great. You talked about, you just talked about process. We talked about process and procedures. When you're using Asana, are you building that? Are you taking your checklist and building that in? Or
yeah.
You are building it in?
We have a template. And so basically when a deal comes across my desk and it passes those first two, I just copy that template and move it over. And it just has all the steps that we want to run through with underwriting as I'm just going down and checking them off.
Got it. And then what are those two steps? What are those first two steps you mentioned, the first two criteria that you use to vet?
Sure. Yeah. First thing is location, right? Where is it located in our market? Are we interested in buying there? And then the second thing is I'll just take a brief look at the financials and see if it just makes sense for what we're looking at.
Sure. Okay. Awesome, man. Awesome. Okay. Now I'm going to move to another question here. Where are you seeing the most profitable investment opportunities, Nick?
As far as like market or?
Well, so maybe a little bit of both, maybe market and asset class. I know you mentioned that you folks focus predominantly on value add opportunities, but can you maybe just talk about where you're seeing some of your more profitable opportunities?
Yeah. I mean, I guess it would depend on what you describe as profitable, but for what we typically do, we're in more competitive lower cap markets.
Right.
So some of the most profitable projects we've come across have been in Los Angeles. And that's mainly because, the cap rates are more compressed and the loss to lease is so much higher that you can actually go in and really increase that value and exit. And that's even true moving forward. Today, I mean, you're seeing some price softening in LA. There's kind of some clouds hanging over with current legislation. So we're kind of waiting to see where that lands.
Right.
But I think both markets, there's just a ton of opportunity in Austin and Los Angeles. But I would say I would never see a property in Austin where the loss, where a unit might be $800 below market rents, but we see that in Los Angeles all the time because of rent control.
Interesting. And so how do you approach that, right? Because, when you have rent control in place and you have that kind of gap or that kind of delta in loss to lease,
yeah,
where is the opportunity, especially when you have a ceiling on how you can, escalate rents?
Sure. I mean, so it's all about navigating those rules, those laws, deftly, I guess you could say. We go in with buyouts is a big one. Go in and when we take over property, we'll assume we'll probably get a third of the residents to accept a buyout. And that could be anywhere from $10,000 to $40,000, depending on how big that loss to lease is.
Wow.
Yeah. Wow. And then at that point you renovate and bring it up to market, and then you refinance a year later and pull it all back out.
And in your experiences, I mean, what percent of, your resident base are you typically exiting with, an offer like that? Is it 20%, 30%? Do you have to buy them all out?
It would be great if everybody took it, because if we're offering a buyout, it means there's a big enough jump there that it would be worth it.
Sure.
Like I said, most of the time we estimate 30% of the building will accept it. Sometimes it's more and sometimes it's less, but.
Wow. That's really interesting to me. That's a pretty high number.
Yeah.
That's a pretty high number. I guess cash is always king, huh?
Yeah. You'd be surprised though. We've given some offers to some people that we thought they would definitely take. I mean, and they won't. So.
And what is the driver behind that? Is it just because the tenants are well enough informed where they know that, hey, this is a pretty good thing and I'm not going to be able to find something comparable? Or
I think it's probably that, and it's also a function of they're not going to find it cheaper elsewhere. And they've also, these are long-term tenants at that point. So they've been in that unit since 2006.
Right.
Or so.
Right.
So.
Right. So it sounds like more of an issue of it just comfortable in that environment, maybe combined with, a rent price that makes a lot of sense, right?
Yeah.
For them. Okay. Yeah. Now I can see why the buyouts are probably pretty important, especially up in LA.
Yeah.
Okay. Awesome, man. Well, Nick, tell us a little bit about, maybe one of your best acquisitions, right? So share a little bit about how you underwrote that thing. I mean, don't go into major detail, but just some preliminary information. Hey, this is what the deal looked like when we're buying it. These are some things that we were considering, we were taking into account, and when we bought it, the outcome was X, and here's why we loved it so much. Everybody, one of the things I love about real estate is, man, you will never have a shortage of stories. Right?
Yeah.
Whether good or sometimes not so good, right? Sometimes no bueno. But I think, one of the things that I love is understanding outcomes, right? And when you can share that in the form of a story, I think they're just easier to connect with and relate to. So can you talk a little bit about maybe an opportunity that you acquired? You had a business plan for it, and man, you took this thing down and it ended up being a great success, and just sharing what that looked like.
Yeah, sure. Our second deal in Austin was a 70 plus unit. It was completely off market. The broker brought it to us as it's an out of state owner. They had owned for a while, and looking over the financials, it typically, honestly, now wouldn't pass our first round of criteria, because just the way that they were allocating expenses, at first glance, it was like, this isn't worth anywhere near what they're asking. But at the time, we delved a bit deeper and saw that there was just tremendous opportunity. And what I like, it was operational upside. We're not banking on the rents increasing. It was, we can definitely run this way more efficiently.
Right.
Which is always kind of daunting when you think, because you're always betting on yourself, but everybody wants to think they can run it leaner. But sometimes you find out you can't. And so when you're basing your acquisition on that, it was a little intense, thinking, what if we get in here and we can't do what we think we can do on the operations side? Luckily we could. And so that's turned out really well. And we also, one of the biggest benefits for that is the manager there is now a manager across two of our properties. So that was my favorite part of the deal, because it's hard to find really great managers.
Right.
So that was excellent. And since we bought that property, it's just performed extremely well.
So let's talk a little bit about that, right? Because, very rarely do you find an operational issue with an asset and you decide to keep on management. Right. I mean, those two components typically don't go together. Yeah. But I've seen that as well. And we've actually made, in this case, I can count 2 acquisitions where that was the case, but a lot of it was just a function of very inefficient accounting systems.
Yes.
So can you talk a little bit about that? Because that's kind of fascinating to me that you've identified all these inefficiencies. Property was underperforming, was an operational issue, but yet you decided to keep management on board, and now the property is a great performer for you. The asset is performing really well. So talk a little bit about that.
I mean, I think you hit the nail on the head. It was a lot of inefficient accounting. And so what we basically did was we have our third-party management company that we've used and we're pretty happy with. And they came on board, and we just ended up hiring, the manager into that company.
Interesting.
And so now they had the processes of that company. They had the backing and the vendors of this large scale company instead of just this one small property. And that helped a ton. But then also, I think the reason that our manager did so well is just the customer service aspect of it that you can teach, but a lot of people seem to lack. And she, had that in spades. And so I think having those systems coupled with that just really was like a great match.
So do you remember what the key issues were that you were able to identify and say, this here's an opportunity for these 5 reasons, And, even though there's some inefficiencies here, I still like, the staff here for these reasons. What were the overriding factors that allowed you really to hone in on the fact that, hey, this was an underperforming asset and we can turn this thing around?
Sure. A lot of it was payroll related. There was an on-site manager who was also getting a unit for free, which, was hurting the property, especially on the 71 units. It was repair and maintenance. It was super high because they were having to subcontract out a lot because the on-site maintenance wasn't as efficient as he could have been. And the contract services were just super high. So their landscaping, their trash, all that stuff we renegotiated and were able to take down.
Interesting. So you were able to identify that right off the bat.
It took a little diving into. I wish I could say I looked at it and just immediately knew. But it's when I started to underwrite, I was like, oh, these expenses are way higher than what we're seeing on our other asset and what we're seeing when we're underwriting other properties. Why is that? Because like I said, my first inclination is, there's a reason for it, right? It's not that I can do it more efficiently. It's like, okay, I'm going to get into this. There's going to be a reason that it's this way. So
Sure. That's a really good approach, right? It's instead of always approaching everything saying, yes, this is, it's yes, this is, but there's a really good reason. Let me figure that out first before I, make my own assumptions.
Yeah.
So I really like that, man. I really like that. Well, Nick, we're getting close to wrapping up this show, but this has been really great because you're getting into things that are not only focus on the acquisition of the asset, but the operations as well. And people just love that kind of information because you have a lot of operators that listen to and watch this show, and then you have a lot of our audience. They're also investors, right? Whether passive or active, and so those little nuggets are going to, I think, bring a lot of value to our audience. So I'm going to ask you a couple more questions, Nick, and then we're going to start wrapping this up. What is one of the common myths about this profession or this business that you feel that you would want to debunk? Let people know that no, it's really not like that.
That it's that you can retire with active multifamily real estate. I think that's a myth. I think there's so much effort that goes into running these properties that if you're going to be active in the property, you should be aware it's a ton of work.
So talk a little bit about that, right? Because I'm really glad you said that, but we also have a lot of investors that are passive inside of our businesses and in our projects. And, I often say that, if I could find someone that I felt would manage the assets the way that we do, I would love to be a passive investor.
Yeah, exactly. Exactly.
So yeah, go ahead.
Yeah. I mean, I think I don't know if it's a common myth, but I definitely hear it a lot. It's, start investing in real estate, run your own properties, buy a few and, retire and live your dream life. And it's definitely, my life is 1,000 times better than it was. I love what I do, but it's still a ton of work. You're still putting in hours each week as an active in a deal, right? As a passive, that's a different story. But as an active, it's like, it's building a business, so imagine you're not just, whereas if you're in a W-2, usually in one role, typically, now you're in a ton of roles and it's all up to you to make it work. So it's fun, it's challenging, but it's certainly not easy.
Right. Well, there is an exit at the end of that tunnel, right? I love this business. It's great. It's, it created just tons of opportunity for me. I meet just some amazing people in this business. Granted, it has its challenges, but that's every single business out there, right? No matter the industry. But, one of the things that I've learned is irrespective of the business, you still have to be able to build things with an end in mind, right? And whether that end in mind is making sure that you have systems that are so great that you eventually can develop someone and train them so that they can step in, right, and manage the asset or the business at a higher management level, and then you remove yourself from that, right? So what is your exit? Because, when you talk about, hey, there's no end game as an active investor, to me, that spells opportunity, right? Because if everybody could do this business, everybody would be in it. And that's just not the case because, we have the levels of commitment are different. And then also our capacity and our ability and willingness to solve problems, very, very different, right? Mm-hmm. You've been solving problems for quite some time now. You're up to 200 units. So how do you see yourself, removing yourself at some point in the future, right? Do you take your assets, do you sell out and now invest with a group or in your own business and, revert to a limited partner, or what's the exit opportunity for you?
Sure. I think you kind of spoke on it already, but one thing we're big about is systems and processes. And as we continue to scale and grow, it's just building out those systems and processes so we can, hire for the positions that we're currently filling and just kind of lead it from a top-down perspective, and start stepping away more and more as we build those people up to run, quantum capital.
Right. So for you, it's really an issue. The opportunity for you to continue to remove yourself, right, mm-hmm. is really, it's about systems or process, systems and people. And of course, training and development. Okay. Makes sense. So the reason why I wanted to spend a little bit of time on that, right, is, I think passive investors have just a tremendous opportunity when they can find the right partners or the right sponsors, mm-hmm. And also the right investment opportunities, right? The right assets, because it's a very unique position to be in where you can, deploy money and really just focus on receiving checks and have someone literally do, 98% of the work for you. But with that said, though, there's also a tremendous opportunity for operators to figure out how to improve their businesses so that they too can enjoy the fruits of everything that they're creating. Yeah, and it sounds like for you and your company, your staff, you've been able to do that with developing good process, good systems, correct?
Yeah, that's the stage we're at. Yeah, it's just getting those developed.
Awesome, man. Awesome. All right, Nick. So what about your least profitable investment opportunity? What did that look like? Same thing, right? The story.
Yeah.
You underwrote to these assumptions after you purchased the property. What made it an expensive seminar? I call these expensive seminars. And I've had a couple. I've had one that was a $2 million expensive seminar.
Sure.
I learned a ton from that. So share with us your most expensive seminar.
Yeah. It was an asset we bought in Austin. And we still own it. It's doing better today, but the first, year of ownership was rough. We purchased it and immediately went from, 97% occupancy down to 83 within a month. We suffered through 3 bad managers. And that's one thing I think people need to understand is you can have a great management company and do all the vetting, but if your on-site staff aren't excellent and they're not good at hiring, you're going to have trouble.
Right.
And then, from then on, it was just, it was an older property. So the maintenance things that we were hoping would last a little bit longer wouldn't. And then it just kind of piled on. It's definitely better now, but all the assumptions we made for year one flew out the window within about 3 months.
And so what did you learn from that? What was the lesson learned, and then how are you applying those lessons forward?
Oh, sure. Yeah. Acquisition side, it's still a great deal, and it's running efficiently now. But when it comes to the operations side, it's just, being a lot more in tune with the residents, and also with your on-site staff, especially when you first take over, really having those weekly calls, making sure you're tracking your KPIs really effectively. And then following up on the property and stopping by and making sure everything's running the way that they're reporting it's run.
Sure. So you're spot checking the asset, you're managing to your KPIs a lot more closely, it sounds like. So are you doing that now with weekly meetings, biweekly meetings?
Yep.
Is it weekly?
It's weekly.
And then how are you doing your follow-up spot checks? What is your process for doing that?
Yeah. I mean, I try to get out at least once a month. to visit all the properties. It's usually more than that, and just come unannounced when I know they should be there and take a look. I want to look at the vacant, the ones that we have vacants. I look at the common areas. I walk around the property, making sure everything looks clean, that the vacants are actually ready. And then, look at the work orders, make sure they're not piling up, and make sure everybody's doing okay. Awesome,
man. Well, Nick, you have been a great guest, very gracious with your time. The information has been extraordinarily, I think, valuable. I've taken about almost a full page of notes, right? So if I've taken a full page of notes, man, I'm sure our audience has been able to receive, the same amount of value and information as well. So I'd like to thank you for coming on and sharing your knowledge, your wisdom, your learning lessons, and finding ways to continue to improve not only our communities, but how people live as well. Nick, how can people get a hold of you? So for our audience that's listening out there and they have an interest in the LA market or the Austin, Texas market, what would be a great way for them to reach out and have a conversation with you?
Yeah, the best way is just through email, and it's just Nick, N-I-C-K, at Quantum Capital Inc., Quantum Capital Inc.com. And that's also our website. Those are the easiest ways to get in contact with us, and look forward to hearing from you.
Awesome, man. Awesome. Thank you. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.